Welcome back to Fast Market here on the TD Ameritrade Network. Let's bring in our next guest for our cash tag segment. That's going to be Andy Swan, co-founder of LikeFolio. Welcome back to the show, Andy.
Yeah, thank you.
All right, so we're talking more retail. Dollar General on tap. I mentioned before the break, the stock's hitting 52-week lows. It's just been on a supreme downtrend here. What kind of data are you guys seeing out of LikeFolio? Does it support this bearish move?
Yeah, it really does. You know, we're not seeing a whole lot of good coming out of Dollar General, which is disappointing considering the macroeconomic environment should be one that really sets up well for this company, especially with food price inflation. You know, we saw that be something that buoyed what Walmart was doing. And unfortunately for Dollar General, we're just not really seeing that much good to talk about. You know, this is a company that each of the last 3 earnings reports has been down 3 to 5% after the report. The stock has trailed peers like Kroger, Dollar Tree, Walmart, and Five Below significantly. We think that there's really good reason for that. You know, basically, people just don't like going to these stores. There's a lot of complaints about, you know, the stores being dirty, the being out of stock of a lot of key items. You know, people just really don't know what they get when they go in there. And to make matters worse, we see complaints pretty consistently from employees of the company that they don't like working there. And so that's kind of a 1-2 punch you don't want to have. You know, as a discount retailer, customers don't want to go into your store, and neither do employees. It's really not a great setup. So overall, we see, you know, Dollar General, as we go into this earnings report, all of our data supports the fact that this stock should be at a 52-week low. You know, the stock has moved down so significantly that it's really hard for us to sustain a big bearish rating, but there's really no reason to be excited about owning this stock. I don't see any reason why executives will be very optimistic on this call. They've just got a lot of problems to get over.
Besides that, Mrs. Lincoln, what'd you think of the movie, I guess, is what we're looking at here. Andy, you know, this is a massive company, 19,000 locations and opening more. But they did say that they're putting $2 billion into CapEx spending to improve, better staff stores, and enhance customer experience. It sounds like, and your data is screaming it, that they need to do that. I mean, if you can't get your employees to come to work, if you can't get a general experience, if people prefer Walmart over you, you got big problems here, Andy. This is a company, it sounds like, from your data, that has an identity crisis.
Yeah, I really think it does, and it's a big shift. You know, 2 or 3 years ago, we were pretty hot on Dollar General. It was, you know, kind of that rural, you know, alternative for a lot of people, and people liked going into the stores. The new stores were very nice. I think they did a good job with that build out, but you just wonder if they've just kind of produced too many stores that they can't really keep up with. And I think that the grocery side of things is where we're seeing the most disappointment, with things being out of stock or expired. You know, and I think that's going to be a key for this company going forward. You know, we do see some resurgence in people talking about it. Most of that chatter, though, is not necessarily positive. And so, you know, as we head into this report, I'm going to be very, very interested to hear what the company's got to say about the grocery side of its business. I think that's what they've counted on, propelling them in this macroeconomic environment, and so far it just really hasn't worked very well.
Yeah, Andy, that was what I was going to kind of pinpoint here, because we saw strong results on the grocery side from, you know, Walmart and Target also. And a lot of Dollar Generals are in, you know, desert islands as far as grocery stores go, or groceries in general. Kevin mentioned 19,000 outlets. If they expand that grocery part of it, is that the key, as you mentioned, you know, even though, you know, they got high inventories, but you'd think in this inflationary pressured environment that Dollar General would just be killing it. And then if they're expanding, you know, a spot that's, you know, in need across the board at a low price point, it seems like it makes sense, but the stock just doesn't react the right way.
Yeah, it doesn't, and it's because the consumer is not reacting the right way. You know, it's great to have grocery options. It's great to have food options. It's great to have low prices on those items. But if when you walk into store, they don't have the necessities that you wanted to take home, or some of those items are expired or don't look very fresh, then the next time you'll drive the extra 5 miles to get to the Walmart and still continue to save the money. I think that's what's happening. And so I think they've got a long way to go. They're in the right spots. This is the right macro environment for them to be thriving, but they're just not. So I think, if anything, the company could say, that they've got tailwinds, because they do. And I do think that $2 billion of CapEx spending will go a long way. It's just, how long will that take for them to turn around the consumer experience at these stores? Because right now it's just deteriorating.
Yeah, rehabbing 19,000 stores, probably a big task at this point. But Andy, do you have an earnings score on this one?
Yeah, we're neutral on it because of how much the stock has fallen. Overall, still remain very bearish. There's no reason, I think, to get out in front of this one.
All right, great data as always, Andy. Appreciate it.
Thank you.